Welcome back, Peter. How are you?
Hello.
Hi,
Hey, thanks
Peter.
for
How
having
are you?
me.
Oh, what a week, huh,
Good.
Peter? I mean, this is
Yeah,
something
what a
that,
week is right.
yeah. So we were showing the monthly candle on the S&Ps, Peter, and here you go. I mean, here's the daily. Now, I was looking for a correction, but even this type of decline surprised me, who was bearish, looking for something like this. How about you? Did the this type of waterfall decline all at once, compressed in time, or maybe this is what the market was set up for?
I think it was set up for it, but I actually think that finally, this is the type of, if you're looking for a short-term bottom, and I emphasize short-term, this is the kind of opening you want. You want to really flush things out, and I wouldn't be surprised if today's opening was a short-term bottom. We've squeezed out certainly a lot of complacency that had been built up into the market over the last month when the equity market thought that everything was contained, that word again, and while the bond market, at least the treasury market, was telling the world that no, it's not. But now that we're going to open around the 200-day moving average, and you usually like to see the opening flush, and then you can at least build a base to grow from. But I want to emphasize short term because who knows what will happen past the short term.
Yeah, look at, I'm showing a monthly chart right here, Peter. We could go all the way back to when the last Great Recession ended in '09, and you don't see a candle like this anywhere
Yeah.
for
So
years. I mean, this is pretty ominous looking. What do you think? The end of the bull market, or just another pause to refresh? I know that's what the bulls are hoping for.
well, I only in retrospect, it's a bear market, but I do think that what was important here is that before we even heard of what the coronavirus was, the economic growth globally has been slowing. And while we did get a little optimistic boost upon the U.S.-China trade deal, I think that the continued decline in the U.S. 10-year and very mediocre data overseas that was not going to be cured by the trade deal because we're still left with all the tariffs, that the coronavirus is a major body blow. And while it's more emotional hysteria than actual health impact, the economic impact of irrational hysteria is real and painful. And I do think that this will sort of flame out in the next couple of months. So the real test will be what kind of economic rebound do we get after that, which will get a rebound. But if it's somewhat muted because the underlying trends of global growth is slowing anyway, I think that would be the most disappointing thing to people. And I think also investors are waking up to the fact that central banks, with the limited ability of rates to
Yeah,
cut and money to print, has very little
yeah,
in tools to address what we're facing right now.
yeah. We
And in
still have a
fact,
little room, but maybe the bond market has already done that for the Fed, and all it is an official pronouncement when they cut. Peter, I was thinking about this. I saw you on CNBC this week where you were talking about now valuations matter. They didn't matter a week or two ago, and now they did. And you're talking about that. Everyone still thinks the Fed put is going to work in this environment. Maybe what we have is a rally into the Fed and a failing rally on Fed action, and that would be the first time people would experience, because they were so successful over all these years, and especially at the end of 2018, to where they gave us a 1-year rally after Powell and Yellen and Bernanke saying kumbaya together. And maybe this is going to be the first time that the Fed will try and be potent and end up looking like the emperor has no clothes. What do you think?
yeah, well, that was the experience of the last two rate cutting cycles.
Okay.
Greenspan fought tooth and nail the decline in tech stocks, but the Nasdaq still fell 80%.
Okay,
And,
you're talking 2000. Okay.
yeah, and Bernanke, of course, did the same and fought tooth and nail and didn't stop what was to play out. So yeah, that is most likely going to happen. Is that the rate cuts will be proven to be impotent. Uh, and interestingly, this is a real test for Powell because I don't know if you saw, but the Bank of Korea overnight was expected to cut interest rates by 25 basis points, and they did not because they basically said that what we're facing here is a health crisis that a rate cut is not going to be able to address.
Yeah.
The person who really disappointed me today was Kevin Warsh, who I thought was a very rational, logical thinker of the Fed, appreciative of the limited powers and major misallocations that the Fed creates. And he's in the paper saying that a coordinated rate cut is what we need. And that's the answer to what ails us right now. I'm just amazed at the complete delusion of that thought from a guy who I thought was a different thinker than that.
Political pressure, perhaps, Peter. And I'm going through your website right here, and from your statement before, you think this is going to flame out. So I want to ask you a personal question. Are you preparing for the possibility of self-quarantine for you and your family?
Yeah, my wife was at the supermarket the last couple of days stocking up.
Okay.
We do have our masks, so yeah,
Okay.
I do think that it's only prudent
You think
to
it's a
do that.
possibility here in the U.S.
Yeah,
that we could have a medical lockdown of major cities?
I mean, I obviously, like everyone else, hope to God that we don't get there, but you never could say never,
Right.
and there's
Okay.
nothing wrong with stocking up the closet for a couple of weeks just in case, because if nothing happens, you can always eat it anytime you want.
I would say that besides the stock market, that if this is the type of thing that can affect everything, right? It starts with the airplanes and the hotels and the travel industry, but how many people are going to be going to open houses this spring? And I
Yeah, I
see
mean
your article here about new home sales.
that's going to be the problem. I do think, and from stuff I've read and people I've heard from, there is the belief that the just like the flu sort of dies out come springtime, that this will happen as well. But that remains to be seen. We just don't know. But I'm hopeful that is going to be the case. And yeah, but the economic impact is real. I think the health impact is, you can't discount it, and it's unfortunate people get afflicted. But if you look at H1N1 and you look at the swine flu and you look at other situations, and the mortality rates were much higher. And most people who get the coronavirus will be just fine. It's the same people that get afflicted by the flu and die from it. They're
Yeah.
the most vulnerable, and it'll be the same situation here. But again, you can't, with the media and precautions and the extent of globalization and travel and tourism, this and that. The economic impact is real, while the health impact is relatively minor compared to other uh, viruses in the
Okay.
past.
So here I am looking at historical lows in 10-year. Um, I was looking for 135, and we're through it. Some people talking 110 on the 10-year, your view. And could this end up being? I mean, we've been in a 30-year, over a 30-year bull market in bonds, and I think we haven't had interest rates like this for hundreds of years. Could this be perhaps the last hurrah in the bond market? And could that be brought on if what the dollar is doing and what the euro is doing? If we're about to enter a bear market in the dollar, it's hard for me to see a continuation of a bull market in debt. What's your view?
Well, I think what follows this economic scare is going to be, I think, a major supply shock that's highly inflationary,
Okay.
that leads to a rise in yields. Because when you think about, I mean, there are U.S. companies out there that can't get product in China that they originally sourced from, and they're trying to find a U.S. based replacement. Well, they're paying 30% higher for that. When China comes back on, good luck getting a ship to bring your stuff over here, because there's a lot of people online ahead of you, that the price increases we're going to see because the flood of the demand that is now pent up relative to the ability of bringing this supply back online, which is going to take time, is you're going to see quite some serious spikes in the inflation numbers. So I'm not a belief that the 10-year yield falls that much further from here, which is obviously breaking below the summer 2016 lows after the Brexit vote.
Yes.
I
I mean,
think,
great time to be unloading bonds if you've owned them a
Dale,
long time.
yeah,
Yes.
longer term ones, yes.
Go ahead,
if
Steve.
if I may interrupt,
Go ahead.
Peter, first of all, I agree 100% with you, having to do with potential inflationary shock, which nobody's expecting, as you know better than anybody. And I've kept wondering about it. The Fed is not even stress testing for any type of scenario that we have a recession and increasing yields. I'm assuming they're not doing that because every single bank would fail. The question is, besides the short-term potential for an inflationary shock, do you also see the dangers of having again an incident of stagflation like in the 70s? The deflationists believe that that is impossible due to the change of demographics. I'm not that sure about it. What do you think?
Well, the inflation shock I'm talking about is more of a cyclical thing. It's not it would just
No,
be
no, no. I get it.
yeah.
I'm asking if you think that this can also be, something more long lasting due to, chickens coming back home to roost, after so many years of reckless monetary policy, etc.
I would say I don't know yet. I think it's possible for the sole reason that services inflation has remained very sticky. Services inflation within CPI, mostly because of rents and healthcare, have been running 3% year over year for years. It's only the deflation or disinflation in goods prices that have kept things low. Now, services, of course, will include shipping and trucking and all the supply issues there. But on the good side, if you get a big rise, yeah, that's going to be inflation. Now, how long that lasts, I don't know. We're going to have to see how it plays out. But at least I know for a period of time, we're going to get some serious inflation surprises to the upside that I think we'll look back on these yields and say, what were we thinking? But we've been saying what were we thinking for years now, particularly with negative interest rates. So I understand where yields are today because of that.
Okay, so we'll have the supply shock at Walmart. Right, Peter?
Yeah, I mean, it's going to be, imagine the rush and the demand to get products and to fill shelves. And if you're an auto company in the US that uses a lot of parts out of China, I mean, it's going to take, the demand is going to come back strong, but it's still going to take time to fulfill those orders. And not just to fulfill them, but to actually procure shipping to get them over here.
Okay. Now this has really taken center stage, but Peter, we're only about 8 months away, 9 months away from a presidential election. Are you starting to add the ingredients of some political uncertainty about which way we go? And do you think that Sanders has it wrapped up? Or do you think that there's so much fracture in the Democratic Party? Could they even put up a contestant that's going to have a chance to dethrone Trump?
I mean, right now, well, I don't discount the possibility of a fractured convention and who knows what comes.
Brokered,
back.
yeah.
Yeah.
Okay.
I think with respect to Sanders, you want to emotionally say he can't win, but in terms of the math of the electoral college math, I just don't see a path for him in terms of the purple states won't vote for him. He would need to win Florida, and I don't see how he would in Florida. He'd probably lose Wisconsin, Michigan, which you need to win because unions don't want to be told that they're going to lose their health care and be replaced by government-run health care like Medicare. I think Pennsylvania and Ohio would be tough to win because he's anti-fracking. So I just don't see the path for him to win, even if he does become the nominee. Now, if he does become the nominee, I'm sure the markets will freak out this summer, and everyone will look at polling numbers and say, wow, he's head to head. But I just don't see how the math works in his favor in terms of the electoral map situation.
Okay, and I know you've been a long time and early on investor in precious metals. They've been performing well. Just a pause to refresh in the gold. The only argument I could come up with, especially if the dollar is turning down, that could break gold would be, you think it's possible one of the biggest buyers of gold has been China over the years, and if the yuan continues to crater, that they could dump some of their central bank holdings on the market?
I don't believe so. I think China has a long-term plan to continue to grow those holdings. So I
Okay.
don't think that'll be the case.
Can you come up with anything that could put a chink in the armor of precious metals with everything that's going on? I mean, you can't think of a better perfect storm for metals here, can you?
Yeah, I trust me. I think all the time what could negatively impact the story, but after a long-term bear market that we saw in gold and certainly in silver. I mean, silver's down still, what, 70% from its highs. I mean, name me one asset that's down 70% from its all-time high. There really aren't many.
Good point.
I think there's still a long runway ahead for them, and that the factors that would end a bull market in the metals is still well out into the future.
And would that be the only thing that could probably do it would be having someone like the great liquidator at the Fed, like Volcker, and higher interest rates, whether
it would be
designed higher yields?
Yeah, it'd be higher real rates.
Okay.
But that's certainly not out there anytime soon, because just as I mentioned, if we're going to start to see an inflation rise, well, real rates will go even lower.
Okay. I know you like some of the overseas markets when you didn't like US. How are those acting this week?
I mean, they're as badly as everything else, but I would honestly be buying Asian markets hand over fist.
Okay, because I noticed on your website, and there has been a day or two where we've been under tremendous pressure, and actually China wasn't. I think you have an article about.
Look at last night, the 8-share index, and I like to look at the 8 shares because the 8 shares in China are could be manipulated by the government. But the 8 shares that trade in Hong Kong and the Hang Seng index both actually closed up last night. Now, whether that's a sign that they think that China, while the first to get it and created the spread of the virus, maybe they're the first to contain it, and now the rest of us have to deal with the spread. Maybe not, but I thought that was interesting. And while those markets are down this week, and they're certainly down a lot year to date, that they actually traded okay this week tells me that maybe the market is thinking that the rest of the world has bigger problems, and that China actually, with their dramatic steps in quarantine, is actually closer to containing it right now.
Okay. Crude oil under pressure, so just part of the slowdown story, Peter?
Yeah, all part of the same trade.
Okay. And banks have they really didn't perform that well when the market was doing okay. So as long as the yields are heading down, avoid banks. Any areas in the market that would be perhaps your first place where you might be looking carnage to pick up?
The best,
oils?
most attractive group, in my opinion, that's going to see the largest snapback at some point are going to be everything travel related, because that's something that bounces right back, whether it's
like airlines,
the cruise lines, the airlines, the casino stocks. They're going to bounce back rather sharply. There's certainly a lot of pain, and I'm not sure when this pain ends, but there's going to be quite a trade there. And actually, I've been recently buying Royal Dutch with its 8% dividend yield.
Okay, Peter, anything you want to wrap it with today, partner?
I would repeat what you said earlier, is that valuations don't matter until they do, and now they matter. So just pay attention to valuations, which have gotten excessive, whether it's in corporate credit, whether it's in pockets of the equity market. and understand that this virus will pass, life will get back to normal, but we could be entering a slower growth period where excessive valuations are not going to cut it anymore.
Okay, and how about subscribing to the book report and show me my membership option. So if you want to follow Peter, here are some of the prices. Look pretty reasonable to me to have Peter's analysis at your fingertips here. So thank you for edifying our community again, Peter, my trading
Thank you,
warrior
Dale.
brother. Yeah, good
Appreciate the
luck to
invite.
you, and you and your family stay safe and
You too.
clean up in the markets, okay?
Yep, thank you. You as well.
All right, thank you. Everyone,
Thanks.
that's
Bye-bye.
Peter Boockvar. You could see him on CNBC. You can follow him on Twitter at @pboockvar. And that'll be a wrap for us today. Good luck out there, everyone. Remember, there's this thing called gravity that's taking place in the market. So don't try and catch a falling knife. I've tried it, and I'm actually trying it again. So you can't break bad habits. And most of all, everyone, don't just count your pips, count your blessings. And we'll see everyone tomorrow. Wrap it up. David Brady will be with us. Thanks again, Peter.